Hi, this is Balaji Jayakumar. I'm a practicing enroll agent. I thought of making this video presentation on traditional IRA. This topic is quite popular on a person making W2 income and also a very small self-employed income. This plays a major role in the savings part on the tax filing. All IRA, it is quite popular in this country. It is a very good tool to make some retirement arrangement. Let us see about IRA a little bit in detail. We should know a little bit about the contribution area and the distributions of traditional IRA. So the conditions and also the limitations on both contributions and distribution. It varies on people to people based on their age and also based on their income limitations. We'll start with contributions. And anyone can contribute to traditional IRA, irrespective of whether they have been covered in their workplace, like 401k plan or so. The problem is they will not be able to take any deduction. They will not be qualified to get deduction if they are covered in their employer place and they fully contributed towards 401k or similar plans. However, if they qualify, they will be able to contribute to the allowed limitation. And about the allowed limitation, we'll see in detail in the coming slides. So the maximum you can contribute is up to $5,500 or up to $6,500 if you are age 50 or older by the end of the year. When you make some contribution, it's the responsibility of the taxpayer to collect Form 5498 from the service provider, the retirement contribution service provider. That is definitely needed. So your accountant should definitely ask for that to prepare for your taxes. So this is a snap of a Form 5498. Showing how it will look like. So every time the taxpayer should collect it from the service provider for the purpose of tax preparation and for their information and record purpose. So when they make some contribution, that will be displayed here in this box, which is box number 1. And if there is any rollover contribution from one plan to other plan, if it is qualified, that will be shown here. And the type of contribution will be listed here in box 7, either IRA or SEP or simple or Roth IRA. So that's all the basic information about contribution. And next, let us talk about distributions. Distributions from traditional IRA is not a good idea. It is one of the painful thing which anyone can do in this country. If for some reason you have to take some money from the traditional IRA, then yes, you have to. So there are some procedures and formalities to complete the taxation at the end of the year if you make any distributions. First of all, if you make any distribution, keep in mind at the end of the year you need to collect Form 1099-R from your service provider. Even though you will get it over mail to your home, you should have a responsibility to ensure that you receive it for your tax purposes. Any distribution you take from the traditional IRA will be taxed as ordinary income. And also the painful thing is there will be a 10% additional tax on distribution, which is like a penalty for the early distribution. However, there are some exemptions on the 10% additional tax. If you qualify to get that exemption, you need to fill form number 5329. This is one of the snap of form 1099R, just for a sample. So if you make any distribution, that will be shown in box number 1, gross distribution. If it is fully taxable, it should be shown here, and the other information will be here. Total distribution if it is taxable. And if there is any taxes withheld, that should be shown here in this box. So that will be taken as a credit from your personal income tax in Form 1040. And to find what type of distribution, that will be shown here in the box 7. The code will be shown, nature of distribution. It might be a rollover from one plan to another plan, that also be shown in this form. So that also will be categorized here in box number 7. And if any state tax withheld, it will be shown here. It's just an illustration about Jane Ambrosia. This person has distributed $35,000. So to have a little understanding how it is taxed as ordinary income, I just made a little a sample work on showing box number 15B. I'm sorry, but box number 15B will show the taxable amount of the distribution made so far. So like I explained earlier, there are some exemptions from the additional 10% taxes. Like there are 12 exemptions. Exemption number 1, it's distribution due to separation from service in or after the year you reach age 55. Exemption number 2, distribution made as part of series of substantially equal periodic payments for your life. And third exemption is distributions due to total and permanent disability. Exemption number 4, it's a distributions due to death. Exemption number 5, distributions up to the paid amount for unreimbursed medical expenses during the year minus 10% or 7.5% if you or your spouse were senior citizens of your AGI. Exemption number 6, any distributions made to an alternate payee under a qualified domestic relations order. It does not apply to IRAs. Exemption number 7, any distributions made to certain unemployed individuals for health insurance premiums. Distribution number 8, any distributions made for qualified higher education expenses. Distribution number 9, any distributions made for the purchase of a first home up to $10,000. Distribution number 10, any distributions made due to an IRS levy. Distribution number 11, any qualified distributions to reservists while serving on active duty for at least 180 days. And the last distribution, it covers any other, so just check for the instruction, and that code has to be entered if the 12th, if it is not covered in the above 11 exemptions. And another important exemption to that 10% additional tax on the distribution is once you reach age 59.5, you can withdraw any amount from your IRA without having to pay the 10% additional tax or penalty. But it will be still taxed as regular income on each withdrawal. And the final thing about this distribution is once you turn age 70.5, you have to distribute required minimum amount. It is called required minimum distributions, RMDs we call it as. So the RMD for each year is calculated by dividing the IRA account balance as of December 31 of the prior year by the applicable distribution period or life expectancy. So this is all about traditional IRA. I'm planning to make another video on SEP IRA. Thanks for watching this video. I hope this video is of little help or little information providing resources. So please let me know if you found some discrepancy or some information is not correct, and please post it as comment and give me your feedback so that which will help me to prepare a little more video presentation on several topics. So my name is Balaji Jayakumar. I am an enroll agent. So thanks and give me your support on this. Thank you so much.